According to supply managers in the 9 Mid-America states, how is the economy performing?
I'll say it's a happy new year coming up. This, of course, is a survey of manufacturing supply managers in 9 Mid-America states from Creighton University here. The overall reading rose to 50.3. So this is above growth neutral after 4 straight months of below growth neutral. So this is up from November's reading of very weak reading of 42.2. So I'd say it's good news, but not that great news. Only 19% of the manufacturing supply managers expect the economy to expand in the next 6 months. 48% expect a decline. So even though they're reporting reasonably good conditions right now, the expectations is not good ahead. On average, 46% of the manufacturing supply managers expect a recession. Of course, that means 54% do not expect a recession. That's the good part of it. So we're moving into the new year much better than what we saw in November. So all in all, it was a reasonably good report. Here I'll bring up a chart showing in blue the overall Mid-America number, which is again is 50.3 there in blue. And the red number, the red line there charts the U.S. number, the PMI, sometimes called the PMI Purchasing Management Index. And as you see, it's 46.7. That was for the month of November. I expect the December number, like the Creighton number, I expect it to be up for the month. Probably not up to above growth neutral, but still up. For things are getting less worse, let's put it that way. And of course, the manufacturing sector has been, I won't call it struggling, but has not been doing well. Job gains have been very minimal. So all in all, I'll just call it an okay end of the year for 2023. We'll see what 2024 has in store for the regional economy.
What were the hiring trends?
Hiring was right in the midsection, right there at 50.0, meaning right at growth neutral. And that's up from November's reading of 42.5. And of course, that's the good news. Approximately 45% reported job losses. Of course, that means 55% either reported job gains or no change in jobs. So again, okay news, much better than what we saw in November. And if you look at non-farm jobs, now that's, of course, we're surveying manufacturing, but if you look at non-farm jobs, up about 1.2% over the last 12 months for the region. Now that sounds good, but not as good as the U.S. The U.S. was up 1.8%. Manufacturing jobs, we had a gain of about 2,800 jobs for the 9-state region. That's 0.2%. That's not that great, of course, but at least it's positive for this month. We had been seeing some negative numbers for the previous months.
What inflation trends are you noticing?
Inflation was a better number. The inflation gauge came down from 71.1 in November to 57.7. So that's the good news. Now the question is, why is it coming down? And we'll talk about that a bit later. The Federal Reserve expects the inflation numbers to be coming down, and they've telegraphed at least some rate cuts for 2024. Now we'll have to see why they're telegraphing those rate cuts. Keep an eye on the month-to-month changes rather than year-over-year. I hear a lot of talk about year-over-year. Well, let's look at November to December. Let's don't look at December of 2022 to 2023. That's a lot of old news in there. The overall CPI over the last 3 months is up by 0.5%, and the core is up by 0.8%. Of course, that's right on target almost on target what the Fed's looking for. It's still a bit high. On the PPI, the Producer Price Index, which we track in our survey, is flat for the last 3 months at 0.0 on the overall. Now the services sector is still up by 0.2%. Of course, that just means 2.4% over the 12 months. So what we're seeing is disinflation, not deflation. In other words, the inflation rate is coming down, and we're probably going to get to the Fed's target of 2.0% in 2024. Now, the question is, why are we getting there? Is it because the rate cuts are providing a soft landing, or is it because we're coming down and perhaps potentially seeing a recession? Is it because of recession? Again, it's disinflation, not deflation. Inflation rate still remains above the Fed's target, but again, moving back down to that target of 2.0 And I think we will see that in the first half of 2024, in my judgment.
What is the economic outlook?
The outlook is continuing to be what I'll call a rolling recession. I've used that term before, meaning some parts of the economy are in recession territory. That just means negative in terms of job growth. The value of the US dollar is down. Now, why is that? Because the Fed is cutting rates while many of our competitors, the OECD nations like Europe, for example, they're not cutting as fast as we're going to be cutting. At least they've indicated that going forward. The Fed's indicated 2 or 3 rate cuts. Investors are in fact, some investors are forecasting 6 to 7%, 7 rate cuts. I don't see that. It's not going to be that. It'll be 2 or 3 at most. Real estate is a real troubling area. Now, real estate, mostly commercial real estate, where we've had some loans going bad and some of the numbers coming down for real estate, commercial real estate primarily. The residential side is still pretty strong, although their supply is limited. Prices are moving up simply because people are staying in their home. They don't want to get out of their home because of those very low interest rates. And we're seeing banking. There are some real issues concerning community banks. Now, the U.S. Treasury and the Federal Reserve is indicating they will take care of the large banks. In other words, too big to fail, as Janet Yellen said. Unfortunately for the community banks, it feels like too small to succeed. I expect no rate change at the Fed's first meeting in 2024. That comes on January the 30th to the 31st. No rate change at that meeting. We may see a rate cut in March the 20th, when it'll probably come down by 0.25% or 25 basis points. Keep an eye on the Federal Reserve's balance sheet. Chairman Powell indicated they will continue quantitative tightening, which all that means is cutting the money supply. They're going to be selling these U.S. Treasury bonds and mortgage-backed securities. Of course, that takes money out of the economy, so that's going to continue to slow the overall economy, even as short-term interest rates are remaining flat. Prime interest rate will remain at 8.5%, which is what we're seeing right now, until March the 20th. On March the 20th, we'll see 25 basis point cut, and that's what I'm expecting. But keep an eye on the bond market. The bond market tells you more than the stock market ever tells you. The U.S. economy is not the stock market. It tends to be the bond market. So as bond yields are coming down, that's indicating that things are moving back in line to the Fed's target, but also means the potential for recessions higher. So the yield on the 10-year Treasury, if it moves below 3.5%, it's about 3.7 to 3.8% now. We're moving into some, I won't call it scary territory, but certainly not what we want to see. Moving below 3.5%, I consider that moving into recessionary territory, but keep an eye on that 10-year U.S. Treasury bond yield. Keep an eye on the Federal Reserve's balance sheet. Is now moving down to $7.5 trillion. That's with a T, trillion dollars. It expanded beginning in 2008. It's still much too high. They've got to sell off those bonds. And of course, that tends to raise interest rates on the long end, not the short end. And keep an eye on the national ISM reading for December, which comes out later on today. I expect it to be up as ours was, the regional Mid-American regional index. Ours was up above growth neutral. I don't expect theirs to be up above growth neutral, but I do expect it to be up. Now, if it's down, that's going to be a bit of a shocker, and that could have some ramifications across the bond market, of course, across the stock market as well. Keep an eye on the price of a barrel of oil. The oil has been moving in the range between $70 and $75 a barrel. If that should move up to approach 80 and above 80, that would be some problems in terms of inflation, and would probably limit the Fed's ability to cut interest rates as we now expect them to. And listen carefully to statements by members of the Federal Reserve Open Market Committee. That's the governors. And of course, there's 7 governors and 5 presidents on the Open Market Committee, at least those voting members. That's voting members. They get to vote on what's going to happen with interest rates. 7 governors appointed by the president, 5 Fed presidents. We'll see those members changing from different money. The New York Fed president of New York Fed's always on that meeting, on that open market committee. Other members will tend to exchange places. So that's what we had for the month of December. Our survey, the Mid-American Regional Survey of Supply Managers, Manufacturing Supply Managers in 9 states, stretching from North Dakota and Minnesota in the north to Oklahoma and Arkansas in the south. It was better than November, much better than November. Still not as good as we need to see, just indicating we're moving into slow growth territory for the region and that, for that matter, the nation. Until we meet again, a happy new year for 2024. And until we meet again on the first business day in February, may your economic cup runneth over, and thank you.